What is up, everybody? Welcome back to Never FOMO, the channel that teaches you everything there is to know about personal finance and investing, regardless of the asset class. So, we cover real estate, stocks, mutual funds, cryptocurrencies, how to analyze a good investment, and how to make wise decisions. Now, today we're going to talk a little bit about the basics of personal finance because there's an interesting move going on in cryptos today that I think has a lot of folks startled, especially those that are new to the crypto world. We're seeing a lot of heavy dips today, multi-percentage drops over the course of the day, 10, 15, 18%. And that freaks a lot of people out when they see those kinds of drops in one day. And what I got to tell people is listen, this is cryptocurrency. It's a very volatile investment. It's risky, and you have to go into it knowing full well that you're going to have some great highs and you're going to have some stout pullbacks because that's what sets you up for the great highs. Before you start investing in something like cryptocurrency, you really need to be wise and you need to lay the proper groundwork in your personal finances to be able to invest and still sleep at night because again it's very volatile, and if you are betting on money you need, that's not the right way to invest in cryptocurrencies. So I'm going to give you Walt Key's wealth building plan, and let me give you a quick disclaimer and a background on me. So I am not a licensed professional finance advisor. That's not what I do. I'm not a stockbroker. I'm not a mutual fund manager, and I'm not licensed in any way to give personal financial advice. This is my opinion. This is my thoughts and data based on about a decade and a half of doing personal finance, both professionally with the Navy as a side job, as well as reading and studying and putting in practical application to all of the things that we talk about. Every single asset class that I talk about on the videos, I have either owned in the past or currently own. So when I tell you about real estate, yes, I am a licensed real estate investor, and so I can tell you professionally what the real estate market is going to do. But as an investment class, I will tell you that I have been and still am today a landlord, a property manager, someone who owns multiple properties in different areas in different states. And so the things that I tell you are not theoretical. I'm not one of those YouTube guys that will espouse an opinion based on some abstract scenario. Everything that I talk about is founded in my own real life experience, my own personal study and application. And so you're getting Walt Key's opinion based on what Walt Key has done in the past to be successful. So let's talk a little bit about what I think the right scenario should play out for you. Now, this, call it a 5-step plan, call it a roadmap, whatever you want. If you are going to make any investments at all, regardless of what asset class, regardless of how risky those investments might be, you first need to start laying the groundwork. That begins with a proper written budget that you can look at every day, print it out, put it on your fridge. So you know exactly what you're working with, how much money you make, how much money you spend, how much money is left over for you to be able to invest without causing you to not be able to buy groceries the next month. This really is the foundation of it all. And so I prefer a very simple one-page spreadsheet because this is essentially a goal for your money. And we all know that goals should be specific and they should be written down. So when you take a goal for your money, a budget, and you print it out and you put it somewhere that you see it regularly, you will stick to the budget better because you're seeing it and it's a constant reminder of what your goals are. This particular spreadsheet, I'm happy to email it to you. Drop me a comment if you like it. I'll send it to you. It is printed in an 8.5 by 11. It covers absolutely everything that you would need. So you can put it practically anywhere. You can fold it up and put it in your wallet. You can print it on your fridge. It makes it really easy to stay on track. And I've been using this specific spreadsheet for personal finance coaching of my entire 2 decades in the Navy. When a sailor would come to me and say, I need to talk to the financial specialist about potentially buying a car or potentially buying a house, or I'm in debt, I need to get out of it, whatever the scenario might be, this is the template that I have used for decades with great success, and that's why I continue to use it. So let's just talk about it real quick. There's a million different ways to do this. You can print it on a Word doc, you can put it on a spreadsheet, you can use an app on your phone now to track this data. The reason I like it in this format is simply because it's easy to print and see repetitively. If you have an app on your phone and you make a monthly budget and you don't look at it for a month, it's really easy to skew off course and not stick to that budget. If you print your budget and you see it every day, it's a lot easier to stay focused on your goals. So let's talk about how the basic budget breaks down. Okay, we've got income metrics. In this particular format, I have base pay, which is your primary paycheck. In the Navy, that's your base pay, and in the civilian world, that might be your check from Walmart, Lowe's, whatever job you have, that's your paycheck. If you make any overtime, you can add it in for that specific month. The beauty of this spreadsheet is you can literally go in and change the tabs at any point. So every month when you set up your budget, if something changed, change it. This is a living document that you can play with, and it makes it very easy. So that's income. And if you needed to add a tab, you simply add a tab. Calculates the total income at the bottom. So let's say I have a side gig, and in that side gig, I'm pulling an extra $500 a month. You can see that it updated for $4,500, vice 4,000. Deductions. Again, add any deductions you may have. In this case, we're looking at federal taxes, Social Security, Medicare, health insurance if it's not paid by your employer, a $100 deduction for your savings account each month. You should be paying yourself first. If you have a Roth IRA, we'll talk about that in a minute. That should be where you list the deduction. Any other allotment or deduction you need to add, you simply add a line, add a number, and it will tally it up for you in the total deductions category. Now we talk about expenses. Obviously, we have our housing expenses. That's going to be a big chunk. Mortgage, rent, whatever your situation might be. Electricity, gas, and you can see we go down the line. These are all the basic living expenses that every person has. If you need to add an expense, you simply tab down and add an expense. If you don't need some of these expenses, you can simply take them out. And again, the expenses will auto sum for you as you add them. Then we have the debts, and this is important because most people have debt. And if you have personal debt, that's not the right time to be investing. And we'll talk about that in a moment. So personal debts, your balance, your monthly payment, and your interest rate. And interest rates are important to track because these can really steal your income away from you. You can see a real live example of some past credit cards. The interest rates are absurd. Now, I don't have personal debt anymore, and I'll talk about that in a minute. That's very important. That's the reason we create the personal budget, is so we can get our money to act the way it should and pay off all of our debt. In this scenario, we have $4,500 in income. We have $800 in deductions. We have approximately $1,965 in expenses, and we have roughly $900 a month in debt payments. And so what that calculates out to for us is our income minus our expenses and debts. In this scenario, we have $835 a month left over with a 20% debt to income ratio. Now, the debt to income ratio is based on your total monthly debt divided by your monthly income. You want to be very careful to keep this number as low as possible. 0 is the best number. Now, so what do we do with the extra $835 a month? Well, if you're in this scenario and you have personal debts, you should be taking this $835 a month and applying it to your smallest debt to get what we call, I like to call debt snowball. You'll hear that term, debt snowball. There's a bunch of different slight variations and they call them something different, but essentially what you want to do is list your debts lowest to highest, and with every little bit of income you can scrape together, you just tackle that smallest debt until it is gone. And then you take that payment you were making and all the extra left over, and you move on to the second smallest debt, and you begin to snowball the size of payment you are making because you're paying off the smallest debts. Get that personal debt out of your life for good. It will suck away your income, which is your number one wealth building tool. You don't need it. So put together a budget if you're not. This is literally step number one if you're going to invest in the future. Okay, why did we do the budget? So that we can become debt free. Now, think about it. If I'm trying to make investments, and let's say I have this $835 a month, and so I'll say, well, I'll sideline 500 a month into investments, and maybe those investments return me an average annual return of 8 to 10% if I'm lucky on a good year. That did not mean to be August. So if we're looking at, gotta love Excel. If we're looking at 8%, maybe 10%, ignore the January, but I'm paying 18 to 21% of my interest out to someone else, even when I have good investments returning me 8 to 10%, I'm still losing ground because I've got these debts sucking away all my extra money in the interest payment. So don't put money into your investments until you've got all of this consumer debt with this high interest rate eradicated from your life. That will then allow you to invest smart. Once you are debt free, I do make an exception for the mortgage because that's a huge expense that you tackle separate. Then you need to put some money aside before you start investing. 3 to 6 months of your living expenses is a very wise number. If your job is very, very secure, maybe you can lean towards the 3 month. If your job is any other Joe Schmo job that could be, canceled on you at any moment, maybe you lean towards the 6 months. So you simply take your monthly expenses and multiply that by 3 to 6. So in this case, we'll call it 2,000. You're looking somewhere between 6 and $12,000 as your emergency fund. That's money set aside for when something crazy happens. And so you don't have to go back into this kind of debt in order to address that emergency. Very important. Now, we've got our debt situated. We've got a written budget in place so we know exactly how much money we have to invest. Now we can start talking about investments. As a general rule, you want to start with more conservative and more long-term consistent investments that take advantage of our tax structure for you long-term. So that's going to be a Roth IRA. Literally anyone can open a Roth IRA as long as you have an earned income. If you don't have an earned income, you shouldn't be investing because you're in an emergency. I don't recommend any one particular organization to open your Roth. You can look at Edward Jones, TD Ameritrade, Charles Schwab, on and on and on. The Roth is simply a tax designation that allows you to invest your money after you've paid taxes so that when you withdraw it, you don't have to pay taxes. So it's a very good investment for the long term. And inside the Roth, I highly recommend some good quality mutual funds. If you want to do an exchange traded fund or an index fund, that's perfectly fine as well. Mutual funds are pretty much the consistent winners in my mind when you're looking for long-term consistent growth. And so I like growth stock mutual funds that have a long track record of performing above their market index. If you've maxed out your Roth IRA, and you've maxed out your spouse's IRA if you're married, because even one income will allow a spousal IRA as well, you might be in a position to have a SEP IRA based on any business that you may own. So for me, for example, I have an LLC that I own that I run my real estate business through. And so that business generates earned income, which allows me to have a SEP IRA as well. So when I max out my Roth, because there is an annual limit set by the IRS for those, I can still put money into the SEP as well. Real estate investments is another great asset class for you to be in. I own multiple pieces of real estate. I've owned multiple pieces of real estate for a very long time. There are different types of real estate investments, and we can talk about those in another video later, whether you want to have a flip business, you want to do short-term vacation rentals somewhere and let it be managed by someone else, or if you want to have long-term rentals in your neighborhood that you can manage yourself, lots and lots of options. All of those are more conservative and less risky investments than general stock market investing and especially cryptocurrency investing. So that is why it's last on the list. Now, I like stocks. I like to be able to analyze an individual company, determine if they have long-term growth potential, and then break down their stock chart and determine the analytics, the technical analysis that tells me is it a good time to buy in the short term. I like doing that. I'm a numbers guy. I'm an analyst by background. I've been doing personal finance and stock analysis for a long time, many, many years. If you don't have the passion to run numbers and crunch data, individual stock investing is probably not the best choice for you. There are some big companies out there that you know intrinsically they're not going anywhere, right? Walmart, Lowe's, Home Depot, Coca-Cola, those companies aren't going anywhere. And if you were to invest in those and dollar cost average over the long term, that would work out fine. But if you don't understand the investment, you shouldn't invest in it. So, for example, even real estate, which I love, I'm a huge real estate guy. If you don't understand how to analyze a rehab project to determine what your cash on cash ROI will be, you should not be investing in rental real estate or flip real estate. If you don't understand how to analyze a company to determine if they are fundamentally sound, you should probably not invest in individual stocks on your own. You should leave that to a mutual fund manager that is licensed and they do it for a living. Same with cryptocurrency. Yeah, I talk a lot about cryptocurrency and I do my best to break it down for you and help you understand it. But still, I would never recommend you put money into cryptocurrency if you personally can't describe what that investment is to somebody else. If you don't at least have enough working knowledge of how the cryptocurrency market works, how to analyze a cryptocurrency to see if it's a long-term sustainable project, if you couldn't explain that to your neighbor in a general sense, you probably shouldn't invest your money in it either. So those are just my personal opinions on how you should set yourself up for long-term wealth. Put your budget in place first so that you can eliminate all of your debt. Ensure that you have an emergency fund in place so you don't have to go back into debt if a true emergency arises. Then lay that foundation for sustained long-term growth with Roth IRAs, mutual funds, SEP IRAs if you have the option, and then start moving into the more developed and more detailed, the more focused investments like real estate, crypto, stocks. You have to lay that foundation. It's almost like a pyramid, right? You have to lay a solid, wide base in order to support the top. And think of that pyramid as a risk pyramid, right? The base is absorbing all of the risk and making it very safe for you to then move up into potentially higher return investments, but certainly more volatile as well. Okay, so that's it in a nutshell. That's what I wanted to talk about today because again, the crypto market just today alone is seeing anywhere from 5 to 6% drops to 15 to 18% drops, depending on what specific crypto project we're talking about. Now, will they go back up? Absolutely. Me personally, I'm probably going to be buying some more very soon because I'm seeing good buying opportunities in the charts. And I'm analyzing the charts very closely right now to determine the right entry points because we may see further drops over the next few days. We have to watch very closely to see when that downtrend breaks. But long term, I still believe there's lots of growth potential. And so I'm watching very closely and I'll probably be investing more. You should not be investing at all until you've done these, at least these top three on this piece of paper. If you don't have a written budget in place, you're not at least consumer debt free, and you don't have some money in savings as a rainy day fund, you should not be investing. Now, with that said, if you're in that position, by all means, dive in and make money. Do it smartly. Do not invest in something that you don't understand And by all means, if there's investments that you'd like to learn more about and you need some guidance and you need some direction on how to do that, drop me a comment below. Make sure you reach over on that bottom right and hit that little hammer icon, smash the subscribe button so you can see the upcoming videos as I post them. Happy Sunday. Don't stress over the crypto market. If you're already in the market, you're going to be just fine. And if you're in a position where you've got some more money to invest, watch very closely. And I think you're going to get some great buying opportunities very soon. Everybody have a wonderful day. Let's go make some money.